During times of high inflation, it's essential to be cautious with your investments. Inflation erodes the purchasing power of your money over time, so it's crucial to avoid investments that will lose value even faster than the overall inflation rate. One of the worst investments you can make during inflation is keeping a large amount of cash in a regular savings account. Savings accounts at banks typically pay very low interest rates, often less than 10% per year. When inflation is running at 5 to 10% per year, which is quite high, your money in a savings account is actually losing 4 to 9% of its real purchasing power annually. The interest you earn doesn't come close to keeping up with the rising cost of living. Investing in long-term government bonds is another poor choice. When interest rates rise, which often happens during inflationary periods, the value of existing bonds drops. So, if you buy a 10-year government bond paying 2% interest, and inflation is 6%, you're losing 4% of your purchasing power each year. And if you try to sell the bond before maturity, you'll take a capital loss. Shorter-term bonds are less risky, but still not a great investment when inflation is high. Stocks can be a mixed bag during inflation. Some companies are able to pass on higher costs to consumers and maintain profit margins. But many companies struggle with higher input costs, wages, and interest rates, which squeezes their profits. Historically, stocks have done okay during moderate inflation, but very high inflation is tough on corporate earnings. Sectors like consumer staples, energy, and materials tend to hold up better than tech and consumer discretionary stocks. Real estate can be a decent inflation hedge, but it depends on the type. Residential real estate often does well, as rents rise with inflation. But commercial real estate, especially retail and office space, can suffer if businesses struggle with higher costs. Mortgage rates that borrow short-term to lend long-term also get squeezed by rising rates. Commodities like oil, metals, and agricultural products often rise in price during inflation. However, investing directly in commodities futures is very risky and speculative. Commodity stocks and ETFs are a bit safer, but still volatile. Precious metals like gold and silver have a reputation as an inflation hedge, but their prices are driven more by fear and uncertainty than inflation itself. So, what should you do with your money during high inflation? The best strategy is to keep your investments simple and conservative. Hold a mix of short-term government bonds, high-quality corporate bonds, and dividend-paying stocks in defensive sectors. Avoid long-term bonds, speculative investments, and anything that relies on low interest rates. Keep some cash on hand for emergencies and near-term expenses, but not too much. And consider inflation-protected bonds like TIPS, which adjust their principal for inflation. The key is to preserve your purchasing power as best you can. Inflation is a silent killer of wealth, so you need to be proactive in protecting your money. Avoid the worst investments, keep things simple, and focus on stability and income. With some smart moves, you can get through an inflationary period without losing too much ground.